Imagine this. You've had a hard day at work, and as you finish up, you check your phone and you see a notification that your investment portfolio is down 20%. Surely it's a mistake. Your retirement fund is down a similar amount. You turn on the news and everyone is going crazy. What happened? Well, we can blame trading algorithms. Right now, they're doing millions of trades a second, but could they actually crash the stock market? Today, we're diving into algorithmic trading. How do they work? And we explore a potential nightmare scenario where they crash the stock market, triggering a global recession. First, what exactly is algorithmic trading? Basically, it's AI or algorithms built on rules acting as digital traders that follow a specific set of instructions on when to buy or sell. They scan markets at lightning speed, spotting opportunities humans would miss or couldn't act upon fast enough. We're talking about trades happening in milliseconds, faster than you can snap your fingers. This isn't just a small part of a market. Potentially up to 80% of all trades today are made by these algorithms. And it's not just a trend, it's completely transformed how markets work. The simplest algorithms follow basic rules like buy when the price drops below $10, but the advanced ones use artificial intelligence to analyze massive amounts of data, spotting patterns humans can't see. They even learn from their own trading history. These digital traders use several main strategies. Some are trend followers that jump on board when stocks are already moving up or down. Others bet that unusual price movements will bounce back to normal, like buying a stock that suddenly drops without any bad news. And the most aggressive, known as high-frequency traders, might hold stocks for just fractions of a second, making tiny profits millions of times a day. So, why have these AI traders taken over Wall Street? First, they're incredibly fast and never get tired, working 24/7 without complaining. Second, they don't have emotions. They don't panic sell during market crashes or get greedy during booms. They stick to their programmed rules perfectly every time. Third, they can be extensively tested before risking real money. For example, by comparing them to historical market data to see how well they would have performed in the past. And finally, they often reduce costs by optimizing when and how to place orders. If you're a big firm wanting to make money, it all sounds really good. But these algorithms aren't perfect. When they fail, the consequences can be devastating. Here are a few examples. Trading algorithms could react to the same market signals in the same way, a little bit like herd behavior. Thousands of these traders all deciding to sell at the exact same moment. This happened in May 2010 when the stock market suddenly plunged 1,000 points in minutes, but luckily recovered just as fast. In 2012, a company called Knight Capital lost $440 million in just 45 minutes because of a faulty algorithm. A piece of old test code accidentally went live, sending thousands of wrong orders to the market. It nearly bankrupted the company in less than an hour. As algorithms become more complex, with artificial intelligence, they become more like a black box. No one knows why they make certain decisions. But what would happen if these risks combined into a perfect storm? So, could they actually crash the stock market? Let's look at an extreme, hypothetical scenario on how that could play out. This day starts off like any other, with everyone going about their business as usual. Behind the scenes, AI algorithms are working efficiently, analysing market trends in order to make money off market movements. A new one, called Colossus, has been rolled out to a number of large hedge funds and trading firms. It's remarkably good at predicting future market events based on subtle signals not obvious to humans. Colossus predicts a minor market correction in the coming days and begins making preemptive moves to sell stocks. However, Colossus isn't operating in isolation for a single company. It has been deployed across a substantial portion of the market. What it fails to account for is that other versions of itself are making identical calculations and trades. As they begin to act in unison, one version's actions trigger another's, creating a cascade effect that generates significant downward pressure even before the predicted event occurs. Within minutes, prices plummet dramatically. Both AI and humans are oblivious to the true culprit at first. Colossus interprets the selling as confirmation that the correction has begun earlier and more aggressively than it had anticipated. Panic begins to spread. Traders scramble to understand what's driving the sudden collapse, but it's too early to identify Colossus as the main culprit. Then 5 minutes in, the first circuit breaker triggers. The market has plummeted 7%, automatically holding trading for 15 minutes. This is a mandatory cooling off period designed to restore calm. Instead, the pause has the opposite effect, amplifying fear and uncertainty. Everyone is trying to understand what is going on. When the market reopens, it drops again, going down to 13%, triggering another 15-minute circuit breaker. After that, it drops further down to 20%. This triggers a trading halt for the day. By now, it's becoming apparent that some AI systems are driving the chaos, but a crucial question remains: who is responsible for it? Are multiple systems working together? Before the next session opens, authorities take most trading algorithms offline, including Colossus. However, some systems remain active as their operators attempt to capitalize on the crash by catching the bottom and riding the recovery wave up. Unfortunately, this strategy backfires. The market continues its descent, though at a slower pace. Liquidity has evaporated, leaving no ability to stabilize prices. Fear now drives the market, creating a vicious cycle that perpetuates the crash. Over the following days, trading continues its relentless decline. The devastation is staggering. Trillions of dollars in market value vanish over the course of the crash. Retirement accounts and pension funds are decimated. The contagion spreads beyond the US borders. Automatic selling mechanisms trigger cascading crashes in stock markets from London to Tokyo, transforming a domestic crisis into a global financial meltdown. This collapse presents an entirely new challenge not seen before. The 1987 stock market crash required 2 years for a full market recovery, while the 2008 one cast its shadow over the stock market for 5 years. It's also been nearly a century since the Great Depression reshaped the global economy. As Mark Twain reportedly said, "History doesn't repeat, but it often rhymes." This scenario certainly isn't guaranteed to happen, but it remains a small possibility. Hopefully it is a very remote one though. What do you think about AI and algorithms trading our stocks? Are you concerned about the risks or excited about the innovation? Let me know in the comments below. Thanks for watching. If you found this helpful, please hit that like button and subscribe for more content.